Welcome back to Investing Talk Podcast. Today, we're digging into Navitas Semiconductor, a company right at the cutting edge of power electronics. And we're asking that big question a lot of you might be thinking, is now actually a good time to buy its stock? Before we jump in, if you find this chat valuable, please take a second to subscribe, like the episode, and maybe leave a comment. And hey, if there's a specific company you want us to look into next time, definitely drop its name in the comments below. So, Navitas Semiconductor, they operate in the advanced power semiconductor space. We're talking gallium nitride GaN and silicon carbide, or SiNC chips. These aren't just, small tweaks. This is the tech making things like our fast chargers way faster, electric vehicles more efficient, and it's even powering things like solar infrastructure and those massive AI data centers.
It really is fascinating. You've got a company here that's positioned right in these essential high-growth industries. But like any investment, right, the full picture needs a thorough look at both the huge potential and the current realities.
Yeah.
We need to weigh both sides.
Okay, let's unpack this then. The last few months have been, quite a ride for Navitas, haven't they? I mean, back in June 2025, the stock actually soared an incredible 246%. That's huge. What was behind such a massive surge, and what really makes this company so exciting from a growth angle?
Yeah, that rally was pretty extraordinary. It was really fueled by a growing sense of excitement around their expanding customer pipelines, and also just the increased adoption of their tech across these key next-gen verticals. We're talking EVs, AI data centers, where power efficiency is absolutely critical, and of course, renewables. It really speaks to the long-term market opportunity here in high-efficiency power semis.
So it wasn't just speculation. There are actual tangible innovations driving this. Can you tell us about some of the recent product developments that are causing this buzz?
Absolutely. So back in June 2025, Navitas unveiled something pretty significant. It was an industry-first, production-ready bidirectional GaN IC. Now, this isn't just a small step. Think of it more like a smarter power converter. It's single-stage simplifying things. The promise is it can cut cost, size, and power loss by over 30%. That's substantial. And it's targeting really hot areas like solar, energy storage, and EV charging. The big question it raises, though, is how quickly can these kinds of breakthroughs actually get adopted widely in the market?
That really does sound like a potential game changer, simplifying power conversion like that. But beyond the tech itself, how is this translating into actual customer wins? Any major examples, maybe in, say, the automotive sector? That's booming.
Right, and that's where it gets really interesting. In July 2025, their GaNSafe platform, that technology, it achieved full automotive-grade qualification. That's a tough certification to get. And it directly led to a pretty significant design win with Changan Auto, a major player in China. They've now racked up over 40 EV design wins globally. And they estimate this powers something like a $900 million EV pipeline.
$900 million.
Wow.
Yeah,
It shows real traction.
And it's not just cars, right? I saw something about AI data centers, too, another huge growth area.
You're spot on. Also in July, Navitas got selected by NVIDIA. NVIDIA,
Yeah.
a leader in AI. They're working on next-gen 800-volt data center power supply development. Think about it. Higher voltage means less current, less heat, much better efficiency for those dense AI servers. This partnership really opens a door for their whole GaNSig portfolio in that really demanding computing space. Engineering samples are due in Q4, so that's something to watch.
Okay, so to support all this growth, EVs, AI, renewables, what have they done strategically? Manufacturing, funding, how are they gearing up?
Good question. They clearly anticipate needing to scale. So in August 2025, they announced a partnership with PowerChip. That's for advanced and, importantly, lower-cost 200mm GaN wafer manufacturing. Scaling efficiently is key. And to fuel the R&D and growth, especially for those AI data center efforts, they raised $100 million. So yeah, these moves show they're committed to scaling up and investing in what's next.
So putting all these pieces together, the tech, the wins, the partnerships, the funding, what does this suggest for the long-term view? Where could Navitas be headed?
Well, looking out longer term, Navitas has some pretty compelling catalysts, I think. You've got the broader adoption of GaN and SuC tech across autos and renewables that seems almost inevitable, right? There's also the potential for more strategic partnerships or maybe even M&A interest from bigger semiconductor firms wanting their tech. And then just the huge tailwinds from green energy and electrification globally. It paints a potentially very bright long-term picture.
That is a powerful story. Innovation, potential being right at the forefront. But let's be honest, every investment has its risks, its challenges. What's the other side of the coin here for Navitas? What are the current hurdles?
And this is where it gets well, complicated. You have this fascinating contrast between that really exciting long-term vision and the near-term financial performance. Despite all the breakthroughs, Navitas has faced some pretty significant headwinds recently. We saw that clearly in their Q1 2025 results.
Okay, tell us about those numbers. What did Q1 actually look like?
Well, look, Q1 was tough. Revenue was $14.0 million. That's down about 40% compared to Q1 the year before. A big drop. Gross profit was $5.3 million, margin around 37.7%. But the really critical figures, an operating loss of $25.3 million and a net loss of $16.8 million for just that quarter.
Oof.
Yeah. So the takeaway is, despite the cool tech, they're currently shrinking revenue-wise and burning through cash. That's pretty crucial for investors.
Shrinking revenues, ongoing losses. That's definitely concerning. Does that trend look like it's continuing? What's the outlook for the next few quarters?
Unfortunately, yes, at least in the near term. Q2 revenue was slightly up, $14.5 million, but management guided for Q3 revenue to be even lower, around $10 million, give or take $500,000. They mentioned China tariff risks and also a shift in strategy for mobile devices, focusing more on premium. But the bottom line is, it indicates they're still having trouble reaching break-even anytime soon. Analysts generally expect losses to continue through 2025.
Right. So with these ongoing losses, how's their financial health holding up? Can they keep funding operations like this? What's the runway look like?
That's a really important question, the runway. So as of the end of March 2025, their shareholders' equity was decent, $341.8 million. And a big plus, they have no senior debt. That's a strength. However, they burned through $13.6 million in operating cash flow just in Q1. So while that equity buffer looks okay now, if they keep losing money at that rate and revenue doesn't pick up significantly, well, it could get depleted. It really raises the question, how long can they sustain this burn without needing more cash? Which could mean, diluting existing shareholders.
That makes sense. Okay, what about competition? They have innovative tech, sure, but it's a massive market. Are they up against giants?
Oh, absolutely. This market is intensely competitive. No doubt Navitas has differentiated tech, but they are fighting giants. You've got huge established analog and semiconductor players like Infineon on semiconductors. These guys are massive. Compared to them, Navitas is frankly subscale right now and obviously loss-making, and the company even flags customer concentration risk themselves. Relying heavily on a few big customers adds another layer of risk.
Okay, switching gears a bit. Forget the fundamentals for a second. What's the stock chart telling us? What does the technical picture look like right now?
Technically speaking, looking at September 2025, Navitas stock has been sort of stuck in a range between about $5 and $6. It looks like a period of consolidation, really, but it follows a pretty clear, broader downtrend. Key support seems to be holding around that $5 level. Resistance looks like it's up near $6, maybe $6.50. So the short-term trend is, well, weak to sideways, basically. And the 200-day moving average, which gives you a longer-term view, is way up around $7. That just confirms the medium-term downtrend we've been in. Momentum indicators, things like RSI or MACD, they're pretty neutral, maybe leaning slightly negative, not signaling a big move either way just yet.
Okay, so putting all that together, the financials, the competition, the chart, what are the key risks for someone thinking about investing in Navitas right now?
I think it boils down to a few key things. First, there's that big question mark over profitability.
Right.
Extended losses, no clear path to break even in the near future.
Yeah.
Then you have those structural risks. The customer concentration we mentioned, the intense competition from the big guys. Plus, the markets they sell into, EVs, solar, industrial, they can be cyclical, demand can go up and down. And always in the background for semis, you've got potential geopolitical issues or supply chain hiccups. Those are always a risk factor.
Right. So we've got this really interesting tension, don't we? Huge long-term potential versus these very real present-day financial struggles. For someone
Absolutely critical. Q3 2025 earnings are expected around October 15th. Investors will be laser-focused on margins and operating expenses, especially after that recent capital raise and the power chip deal. Everyone will want to see if those moves are starting to make any difference on the bottom line, or at least showing a path towards it.
Okay, what else is on the calendar?
In November, around the 5th, we get the institutional 13F filings. That's when big money managers have to report what stocks they own. It gives you a sense of whether the big funds are buying, selling, or holding Navitas. It's a sentiment indicator. Later in November, maybe around Black Friday, Cyber Monday, you might get some hints from charger sales trends. A bit anecdotal, but still could be interesting. And then, December 10th, 2025, Navitas has an Analyst Day scheduled. That could be really important. They might give a 2026 guidance update, looking further ahead.
Okay, so that's the official stuff. What about unofficial? Any whispers, any speculative catalysts floating around that could potentially be transformative?
Well, there are always rumors in this space, right? Some are pretty interesting if they pan out. One big one is the potential for a major U.S. automotive EV OEM win. Landing a contract with, say, a Ford or a GM for their EVs would be huge validation. Another bit of chatter is about expanding those AI data center deals beyond just NVIDIA. Talk of other big cloud providers maybe evaluating Navitas tech. That would be significant too.
Anything else on the speculative front? Maybe broader market factors?
Yeah, analysts sometimes talk about the possibility of faster tariff resolution, especially with China. If those semiconductor tariffs were eased somehow, it could really help Navitas's costs and margins, given the global supply chain. And finally, you occasionally hear those unverified reports about M&A interest. Larger semi companies are always sniffing around for innovative tech like GaN and Dilsing. So, acquisition isn't out of the question, though it's purely speculative.
Okay. So we've looked at the amazing potential, the tough current financials, the things to watch. It's definitely a complex story. For someone listening, trying to make sense of it all, what's the overall takeaway? How do you weigh that innovation against the numbers we're seeing right now?
That really is the crux of it, isn't it? So, based on everything we've discussed, pulling together all the analysis, our overall investment rating for Navitas Semiconductor, as of September 2025, it comes out as a 4 out of 10.
4 out of 10. Okay. Can you break down why? What are the main strengths pulling it up and the weaknesses dragging it down to that score?
Sure. On the positive side, the strengths are clear. Navitas is playing in a fantastic long-term market. High-efficiency power chips like Ghana and C2C,
Yeah.
that's the future, no doubt. And financially, they do have that decent equity buffer and, importantly, no senior debt.
Yeah.
That gives them some breathing room, some stability.
Okay. And the weaknesses driving that 4 rating.
They're pretty significant, unfortunately, and mostly near-term. You've got that sharp revenue decline we saw in 2025. You've got persistent operating losses. And crucially, there's just no clear visibility on when they might reach profitability or get strong operating leverage. From a market perspective, the stock's still in a downtrend. Momentum is poor. And competitively, at their current size, their position feels speculative. They could be vulnerable if the market gets risk-averse or if investors just lose patience with the losses.
So what does a 4 out of 10 mean for different kinds of investors? Is there anyone who should consider buying right now?
Look, for short-term trading, there just aren't clear catalysts, and the trend is weak or sideways. Not much opportunity there. For long-term investment, it really should be viewed only as a highly speculative position. It's for investors with a very high tolerance for risk, who are essentially making a multi-year bet that GaN and CXAT technology will eventually dominate and Navitas will be a major winner. For more conservative long-term investors, as of right now, September 2025, it's just not an attractive option. The risks are too high, the profitability too uncertain.
That's a really insightful breakdown. Navitas Semiconductor, definitely a company with exciting tech, a foot in critical future markets, but facing some serious, immediate financial headwinds.
Exactly. It's a classic case, really, that highlights how important it is to balance that exciting vision and innovation with the hard realities of execution and financial performance today. You have to recognize that huge long-term potential often comes packaged with near-term volatility, and it requires really careful ongoing monitoring.
A very thought-provoking point. Thank you for walking us through all that. Hopefully, this gives you listening a much clearer picture of Navitas Semiconductor. Ultimately, I suppose Navitas forces us to ask, how much patience do you have? Is this a long-term bet on the undeniable future of GaN and 6-key? Or is it a cautionary tale about the challenges facing innovative but currently unprofitable companies in a really tough, capital-intensive race? Something to definitely think about. Don't forget to subscribe to Investing Talk podcast, like this episode if you found it useful, and leave us your comments below, especially if there's a company you'd like us to take a look at next. Until next time, keep learning, keep questioning, and keep investing wisely.